Hey, good morning, options traders, and I hope everybody's gearing up for another big day in the market. But in all of my videos, or at least most of them, I'm in some form or another talking about hedging versus speculating. And hedging is really what options were designed to do, to be hedging tools. But because they're such powerful hedging tools, they can also be great speculating tools. And I've had some traders asking, well, what's the difference between these two, and why does it matter? Well, let's start with hedging. Whenever we're talking about hedging, the key idea is that you're trying to offset losses. So in this case, maybe one asset gains while another loses. So they're acting like a counterbalance. One's going up, the other's going down. So probably the simplest way to talk about a hedge is that you put these on if you're trying to reduce the pain of potential losses. Not trying to eliminate it, as you're going to find out you really can't eliminate it, but you can certainly reduce it. Now, of course, that sounds like a great idea, but you're also going to reduce the gains. So that's really the key idea of a hedge. You're trying to reduce the pain, but you're willing to sacrifice some gains. So you're really just seeking insurance. It's really the same idea of the insurance market. If you buy car insurance, that's a hedge against losses. So for instance, let's take a look at a strategy called a protective put. So maybe you buy shares trading for 100, and then you buy one $100 put. So that's our $100 strike. So if you bought the shares just by themselves, this is your risk graph. So because you paid $100, our graph crosses zero, this horizontal line, that's where you would break even. But you can see that you've got the ability to make unlimited gains, but you can also take some sizable losses. Typically we call these unlimited, even though they're technically limited, but there's certainly some very large potential losses. But if you buy the protective put by itself, just that $100 put, that risk graph looks like this. So let's say that we paid $5 for this put. That would be the maximum loss, and that occurs for all stock prices above our $100 strike. That's why this blue line flattens out. Put options expire worthless at the strike or above at expiration. So that's the worst that can happen at expiration. We just lose our insurance premium. But if the stock price falls below 100, look what happens to the put. Do you see how this blue line ramps up in this direction? That's because a put option acts like short shares of stock. It has negative delta. Look at the red line down here. Do you see how it slopes down? And this red and blue line, at least in this region right here, are almost mirror images of each other. They will tend to cancel. So for instance, let's say that the stock is 80 at expiration. If you paid 100 for the stock, you're down 20. What's the put option worth? Well, the $100 put with the stock at 80 is worth 20, but because you paid 5, your profit is 15. So think about it. If you lose 20 on the stock, but you gain 15 on the put, overall, you would lose 5. You're going to get the same answer at 85, 90, 95, all the way up to this $100 strike. You're just going to lose 5. So the combined effect of this red and blue, if we had both of these positions in our account, is actually going to look like this. So now you can see that that line has flattened out to the left. So there's our maximum loss. Now what's interesting, notice how the loss is over on the left-hand side of our strike. On the previous slide, it was on the right-hand side, and that's because we hedged those potential positive deltas down here on our stock. Those negative deltas on the put came to our rescue, and they acted as a counterbalance. Stock going down, put going up, we tended to offset those losses. Now, of course, we didn't completely eliminate them. That's why we have a $5 loss. And that's because you never get your insurance premium back. That's why you can never, ever create a full hedge that completely eliminates all losses. That would assume that somebody gave you the put for free. Now, because we paid $5, we can see the trade-off. If we overlay the original stock position, there it is. So why did we do it? Why did we put this protective put on? Our main reason was to eliminate the pain. Now, we didn't completely eliminate it, but we sharply reduced it. No matter how far the stock price continues to fall, we're not going to take that ride because we're now maximum loss of 5. But again, did it come for free? No, take a look. If we were highly confident or willing to take all of the risk that the stock was not going to fall, why buy the insurance? Do you see how this red line sits above the green? Well, that gap right there is the $5 that we paid for the premium for that put. See, that red line sits higher. We would have been better off by $5 had we not bought the insurance. So as I said before, you're reducing the pain in exchange for reducing, at least somewhat, the upside gains. See, we still have unlimited gains with our stock plus put position here in green, but they're just not as profitable. All right, so if that makes sense now, that's really the idea of a hedge. Reduce some of the pain in exchange for giving up some of the gain. Now, what about speculation? Now, speculation is actually just the opposite. Unfortunately, a lot of times traders think that speculation is, I think the stock is going higher, and that they're just kind of winging it off of a gut feeling. That's partly true. There's probably some element of, let's call it guesswork in speculation, but it's really more than that. Because if that was the definition, even buying a protective put would be speculation. You're still guessing that the stock price is going to rise. So there's more to it when we talk about speculation. So speculation means that we are trying to put on a position that magnifies the gains. We are trying to accelerate those, but in exchange for that, we are going to increase the chance for losses. Now, those losses might actually be smaller in terms of dollars, but there's going to be a greater chance for a loss. So, in a sense, we are increasing the good while increasing the potential for bad outcomes, exactly the opposite of a hedge. So let's say that one trader buys stock for 100, and instead we buy the $100 call for 5. Now notice that we are controlling 100 shares of stock for only $5. So 100 divided by 5 is 20. We're paying 1/20th the price of that stock. So in financial terms, we would say that we have 20-to-1 leverage. There's a lot of different ways we can calculate leverage for options. This is one of them. Just divide out the current stock price by the option's price. And that means that our gains should be magnified by a factor of 20. So let's take a look at this $100 call position. And if you're thinking this looks an awful lot like our long stock plus put, good observation. Stock plus put is a synthetic call. They behave exactly the same way. So a call option can be viewed as insured shares of stock. So when you buy a call, you do, to some extent, have a hedge. But because we can lose 100% of our money if the stock hits 100 or lower, we have a higher probability for loss, albeit a smaller loss. So how are the gains going to measure up out here? Let's say that the stock closes at 120 at expiration. Well, the stock buyer that paid 100 is up $20 or 20%. With the stock at 120, the $100 call would be trading for 20. And so when we sell that, that's a $15 gain for us or a 300% profit. So look at the differences in those returns. We've magnified them in exchange for a higher probability for a loss. Now, as a little bit of a side note, on the previous slide, I said we had 20-to-1 leverage. So if we take 20-to-1 leverage times the 20% gain of the stock trader, comes up to 400%. Why didn't we get 400% on our money? Well, again, in a sense, we did. The option was trading for 20, just like the gains of the stock trader. But we have to back out the $5 we paid, remember? That's why our gains are at 15, and therefore if you pay 5, you sell for 15, it's a 300% gains, at least in terms of the profits. But you can still see that we've greatly magnified the returns in exchange for a higher probability for a loss, and that is speculating. So these are important concepts for our new traders because you need to know that when you're setting up your trades. Are you speculating? You need to make sure you're setting up the trade correctly. Are you looking for a hedge? It's a different story. Be sure you're setting up the trade correctly. So if you're setting up your trades based on bad information, you're never going to get a good outcome. So for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new technical analysis course It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.